Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Paul Sweeney, along with Tom Keene. Join us each day for insight from the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Let's check in with Jay Hatfield. He plays in this part of the world a lot. Jay Hatfield is CEO, founder, and portfolio manager at Infrastructure Capital Advisors. Jay, I know your long career, you've long looked at, invested in, thought about China. What do you make of some of the recent moves by this Chinese government to try to reinvigorate its economy?
Well, we've actually been more optimistic about the Chinese economy for a while for really two reasons. And that is that, first of all, everybody ignores the fact they save 45% of their GDP. We talked to you folks were talking about.
We don't do that, do we?
No, we do not do that.
You might not know.
My personal account.
We were talking about, or you were talking about before, our fiscal irresponsibility. So we save about 20% of our GDP, China 45%. They can invest that badly, like say 10%, and get a 5% growth. So everybody kind of ignores that, focuses just on property. But we've also been thought actually that this would occur because there's one and really only one advantage of a centralized economy. And that is if you have a crisis, you don't have to have Congress arguing about it and saying it's a bailout. It's just a bailout and it happens big and anybody complains, plays the consequences. So when they decided to deal with this, which was just, I guess, a week ago, you get this kind of power rally. I noticed the CSI is only up 9%, so it's cooling off a little bit for the day.
Right.
But so that's the key is a lot of money to put to work and a powerful central government that can solve the problem. And also pretty tight monetary policy up until now. So it's not like they've been super loose and now getting even looser.
You talk about a crisis. I'm very curious about why this moment as we head into this holiday, but why they decided to do this now. And then you talk about that savings rate, and we're well acquainted with the kind of property crisis we've seen across the country. How difficult is it going to be for them to change what are here kind of economic and cultural habits of the country to get them to spend more and to deal with this property crisis?
Well, I think that actually it all came from policy in the first place. It was really a crackdown on wealthy, influential people, which the party thought was a threat to their power.
You want to be big, not too big.
And so they just were running with that. And then at some point they realized, oh yeah, that's right. People do care about economic growth, or we do care. So we have to come back to that. So it's really just authoritarian flip-flop.
So how does the politics figure into this? Because, I would think that the China economy really cannot fully recover without really aggressive trade with the rest of the world. How do they think about the U.S. and the rest of the West in terms of trade? Because it just seems like if you just provide some stimulus, that's not going to get it done.
Well, I would still go back to if you've saved 45%, you can paper over a lot of problems.
Okay.
And so there is going to be pressure from additional trade restrictions, particularly if Trump becomes president. But it's important to note that if you have fiscal and monetary policy firing, you can deal with a lot of problems on the trade front.
You mentioned if Trump wins. Let me just get your perspective on the election here in the U.S. and sort of how you're thinking through what may or may not happen here in the next couple of 6 weeks. 6 weeks to go here, yeah. And there's a lot between now and then. How are you framing or thinking about the election and the impact it's going to have globally?
We're not far off from your prior guess. Maybe we get there a little bit differently. We're not pollsters, so we look at gambling odds. Those are sort of markets. If you look at the cumulative probabilities, you get close to the same result as your prior guess. 12% chance of a Republican sweep, 8% Democratic, so it's 80%. 80% is good in our political situation. You want divided government. Each side kind of fights the other spending, so you have less spending, less change. We don't want an increase in corporate taxes. That's a terrible economic policy, and it's terrible for stocks. So Democratic sweep, irrespective of politics, wouldn't be good for the stock market in the short run. You get a lot of capital gains harvesting, which we normally don't get. So you would get a really weak market and a Democratic sweep case, but that's only 8%. So we're focused on the 80, and we still have a 6,000 target, which looks too conservative right now. But we're not going to raise it because it's already pretty aggressive. Yeah. It's 21.5 times next year's earnings.
30 seconds left. You still like the banks?
We do. We think you should be out on the risk curve. So that's banks, REITs. Tech is probably going to underperform. On the fixed income side, preferred stocks are likely to continue to do well. They've been doing really well. So take more risk, go out on duration, because all these global rate cuts are very powerful and drive global rates lower.
Next time you walk in the studio, just say preferred stock, and we're going to do a whole segment on preferred stock, because we never talk about preferred stocks.
Yes.
It remind me, because I used to make a lot of money selling those things back in the day, and nobody talks about them anymore. I guess, I know, interest rates were zero forever. So Jay Hatfield, CEO, founder, and portfolio manager, Infrastructure Capital Management. We appreciate you coming in studio. Talk to your public relations persons about timing that whole thing. So anyway. Henrietta Treyz joins us, managing partner at Veda Partners. Henrietta, what moves the needle, if anything, between now and November 5th?
Great question. We really only have one predictable event left, and that is tomorrow night's vice presidential debate between J.D. Vance, who is currently over 10 points underwater in the favorability ratings scale, and Tim Walz, who is ahead by about 3.5 points. So I'm expecting more of attention on turning out the vote as opposed to specific policy prescriptions out of the 90-minute debate tomorrow night. I imagine they're going to try to not just reach voters who are watching in real time, but all the ones who will catch up the next day on social media with the memes. And everything that I'm anticipating is really just expecting a meme-worthy event more than a policy-heavy event.
A meme-worthy event. Henrietta, how much does this debate matter? I think back on past vice presidential debates and more conventional campaigns, often sandwiched between presidential debates. Seems like we're not going to get another one of those. How much does this matter? And let's take each of the two candidates in kind. What does each have to do on stage tomorrow here in New York?
Yeah, I don't think that based off what we saw from the first presidential debate, which has a lot more at stake, there wasn't a ton of movement in the polls following. People did get to learn about Kamala Harris's policies, and they were received favorably. And the most memorable moment of the night was probably Trump saying, eating the cats, eating the dogs. Something along those lines is more what I'm expecting to come out. Tim Walz is the most non-understood, least known candidate on the field versus J.D. Vance. And so I think that there's potential for him to lose vote share and see that plus 3% favorability rating drop. That's usually what happens. People like you less after a debate than they saw you before. That's not the case that we saw with Kamala Harris, but there is a lot of room for Walz to go in either direction, whereas J.D. Vance's numbers are pretty baked in and then been very consistently underwater since he got into the race, -10, -13, and thereabouts. So I think J.D. Vance has the most to gain tomorrow night, and Tim Walz is at risk of becoming more well-known and then therefore less popular. So that's probably the starting point I'm going to go into it with.
Henrietta, I saw all over the weekend that Kamala Harris raised $55 million in California fundraisers. Does that even matter anymore? I mean, I just don't know how you appeal to those 5 to 10 to 15 million voters that supposedly are going to decide this thing.
Yeah, I was actually just looking at the numbers, and I have to read them a couple of times. The Harris-Walz campaign raised $287 million in August versus $85 million for the Republican ticket. So there is this huge deluge of an enthusiasm represented by these numbers. But what I would anticipate and what I focus on a lot, because I think it's more important for the tax bill, is where that money is being spent. And a lot of it is trickling down ballot. So you see Republicans now defending Senate seats where they should otherwise have no business spending money. States like Texas and Florida, for example, even Iowa. And then Nebraska would be another example. And then down ballot even further on the House side, the Democrats have just expanded the map into non-swing states, into states and districts where maybe Biden won, but maybe Harris is potentially going to pick up tiny little pockets of the population. And that's her campaign strategy. Go into the suburbs, go into some of the rural areas, whether it's in Pennsylvania or North Carolina or Georgia, and really try to speak to voters exactly where they are. So think of the money not in terms of what it can do from a big picture perspective. Everybody's already bought their ad campaigns, but think about how it fuels up the gas for a tour bus for House and Senate members to go on tour in their districts. That's where all that money is being plowed into. And that's going to be the difference between a split control of Congress next year, or a sweep for one party or the other.
The Harris campaign spending an average of $7.5 million a day in August, compared with $2.6 million a day Donald Trump. Wow. Henrietta, you mentioned the tax bill. How are you thinking through the likelihood of there being significant changes to the tax code? You mentioned that debate between Vice President Harris and former President Trump in Philadelphia, and we got more economic policy points from her on the heels of that. So much of this hinges on who's in Congress, what the dynamics there are. Walk us through sort of how you're thinking about that amidst all this uncertainty at the presidential level. How should we interpret what these two candidates are saying about taxes in light of the fact that they're going to have limited power to do much without Congress?
Well, I'm going to be kind of aggressive here and say the two sides are not far apart at all. And the election outcome, I think, is going to be pretty easy to translate to tax policy. Here's why. If Trump wins, with 90% odds, I anticipate he'll have a Republican Senate. And with 60% odds, he'll have a Republican House. So that's one party control. All of the tax cuts will be extended at their current rates. I do not think the corporate tax rate will drop. There are not enough votes for that in the United States Senate. The SALT cap will go to 20K or thereabouts. We will not repeal the IRA tax credits for manufacturing, et cetera, et cetera. On the Democratic side, if Kamala Harris wins, I still have 90% odds that the Senate is going to be Republican. What happens in that universe? Exactly what happened in 2010. You get a 2-year extension of all the existing tax breaks for every income bracket. You raise SALT to maybe 40, 60K. You provide a child tax credit, which is in about another $1 trillion. And you maintain all the IRA tax credits. That's going to be your bill if Kamala Harris wins. The idea where Democrats have a sweep control is only a 10% prospect, in my opinion. So effectively, what I'm saying is no matter what happens at the top, you're going to get a 2-year extension at a minimum of all the existing tax breaks. That's a blueprint that we've had all year long. It's not that confusing. It seems really clear to me. So that's what I'm expecting next year. We'll deal with the debt ceiling first, and we'll send the second half of the year on taxes, pass it in late December, and everything will be extended for 2 years at a minimum.
No equivocating there, Paul.
No. I mean, that's why Henrietta is the best. I mean, it makes it pretty clear here. Henrietta, from a political perspective, does anybody care about the debt and the deficits and things like that? Or from a political perspective, is that just the third rail and there's no upside?
They sure don't. You look at the policies that have been enacted, not just since COVID, but going back, as I went back to 2010, there's just not a concern about the deficit and federal spending right now. I have this conversation a lot with foreign clients where they're saying, surely America's going to get concerned about this. And then you come over to the States and American investors do not follow this nearly as much as overseas investors. And I can promise you that in a campaign and election year, Democrats and Republicans are not thinking about it on Capitol Hill. The scenario where Harris wins and we get a 2-year extension of everything means that in that interim 2 years, 26 and 27, we have another round of fiscal negotiations around a Simpson-Bowles-esque bipartisan deficit reduction compromise. And unfortunately, I'm going to default to the base case, which is that even after those commissions are organized, nothing changes.
We see Donald Trump heading back to Wisconsin. He was there last week. He's going to go there again on Tuesday after a stop in Georgia. Kamala Harris out in California, then in Las Vegas. She's going to go visit FEMA headquarters today after what happened over the weekend with the storm in the Southeast. What would you, if you were running these two campaigns, we know what the swing states are, the 5-6 swing states, what would you be prioritizing at this point? It's interesting just to kind of divine based on their travel where these campaigns think they need to be spending the most time. You talked about Pennsylvania a little while back. It seems like that is the magnet that is drawing them back to Pittsburgh over and over and over again. Where should they be focusing on this point, and how resonant do you think their message is when you look at that kind of granular level?
Instead of repeating something that is very fair but often stated by people watching the polls, Pennsylvania is critical. the money that Harris has raised allows her to, juice up a tour bus and go to the different suburbs and rural areas of Pittsburgh and the outlying areas and really turn out her margins where possible there. But to tie it into the hurricane, the hurricane went straight through a Republican voter warpath, and it is decimated huge swaths of the country in that exact area. I think that the Trump campaign should spend a lot of energy talking about mail-in balloting to those voters who don't have the infrastructure and will not, will be busy rebuilding their homes and maybe not available to go vote on the first Tuesday in November because of the destruction that the hurricane has caused. I would spend all my resources on shoring up those votes that are already locked in for the Trump campaign, but now are very much at risk of just not showing up because of the destruction that just occurred.
Wow. All right, Henrietta, I appreciate you tying all that in for us. Henrietta Treyz, managing partner at Veda Partners. Boy, from my perspective,
hugely useful.
Nobody better and kind of bringing it all to the front here. Looks like we're going to have some labor strife on the eastern docks here in ports along the East Coast and the Gulf here. It just doesn't seem like these two sides are making any leeway or any headway in terms of these discussions. Let's get the latest reporting from Dani Burger. She's a host of Bloomberg Television. Dani, I see you, and our folks on YouTube can see you standing at a dock somewhere. That is ground zero for these discussions. What's the latest reporting?
Yep. I'm at one of the busiest docks. I'm in Newark, and docks like this have been preparing for a strike at the strike of midnight tonight. They've been extending hours because by all accounts, this will go ahead. There are no current talks scheduled between the Longshoremen Association, that is the union that represents the Eastern and Gulf ports, and the employers. There are two main disagreements that this is over. One is about pay. They want a significant pay rise, some 80% over the next 6 years. The current offer on offer, they say, is stingy. The second thing they want is they do not want automation. They want things written into the contract that says that there will not be more automation on the docks, akin to what we have in Asia and Amsterdam. Now, the workers here, they do have significant leverage at this moment. For one, they have an administration that is friendly to labor, and they also have the supply-demand issue. There are not enough people who want to do these jobs. So they have the kind of leverage that, ironically, in the first place, is why so many of these docks want to automate a lot of these jobs.
So what's the latest here, Dani? Where are these two sides? I mean, this sounds like they're not even close here. What are the next steps, really?
So they are far apart. You're completely correct. They're so far apart that there are no talks that are scheduled for this moment. Some of the steps that we have seen that's kind of occurring in the background is the administration trying to mediate this. Again, the administration is in a catch-22. They want the union support, so they don't want to step in and prevent this strike from happening. But at the same time, they don't want the economic damage. So the strike will happen 12:01 a.m. on Tuesday. Then talks will presumably happen. Now, by most accounts, experts we speak to think that this will only last for a few days. There is significant pressure here, considering the money, the economic impact that is at stake. But again, the Longshoremen Association say that they are ready. To quote the head of the Longshoremen's Association, he says that a sleeping giant will be awakened come tomorrow morning.
All right, Dani, thank you so much for joining us. Dani Burger, host of Bloomberg Television, live reporting from the docks in lovely Newark, New Jersey. I was over in the motherland, over in Ireland last week, seeing the people, seeing the family. Apparently, Japan, the PBOC was pretty active last week, David, and I think that's good news. Certainly good news for folks that own Chinese stocks like Alibaba, but what does it mean here? Amanda Rebello joins us. She's head of Xtrackers Sales, U.S. Onshore at DWS Group. She joins us here in studio. Amanda, thanks so much for joining us here. Again, what did you make from the PBOC last week and what they're trying to do to the Chinese economy here?
Yeah, absolutely. It's really interesting. China is something that we're always speaking about at Xtrackers. Yep. So we launched the first A-shares, direct holdings of the China A-shares with a Western asset manager almost 10 years ago, actually, wow. Okay. In Europe and then also in the US as well. And so we've now become like the default for that exposure. So we were pretty busy, to say the least, on Friday and actually today as well. PBOC on Tuesday, they announced a number of stimuli which were then effective as of Friday. So we saw a really big jump in the market. I think all of us know that China has been really out of favor for international investors for the past couple of years in particular, was definitely a darling, but I would say post-pandemic has never really kind of got back to where it was. Obviously, we've seen the cut in projections regarding the target GDP growth that the government has been expecting. Historically was around 6.5%, came to about 5%. But there's been a lot of cynicism from Western asset managers, Western investors over the past couple of years about whether the 5% was actually achievable. And so what we saw on Friday effective was some changes in rates policy more broadly. So first of all, we saw decreases in the reserve requirement ratio, and then we also saw a cut in the 7-day reserve rate as well. What these two together have done is that actually it's injected the Chinese economy with 1 trillion yuan, which is now available for investment, and the market received that pretty well. So we actually saw on Friday the market, the CSI 300, increased by just shy of 4.5%, and then it's closed at over 8% up on the day, which is incredible.
It's
so
being called the PBOC put by some
exactly.
people, I know.
And we don't think it's over as well. That's
you
the
think
thing.
There's more to
so
come?
More to come, yeah.
I'm curious, you talk about the sort of investor skepticism that there's been the backdrop to all of this, and I wonder how curative you think these efforts are going to be in allaying those concerns. So given that skepticism or fear about the state of the Chinese economy,
Yep.
Is this in a way alarming? Does it engender more confidence? How do you see it sort of playing out, I guess, attitudinally?
I think we've seen it as pretty positive. We and also our joint venture partner Harvest, who are headquartered out of Beijing. And so, even though they are headquartered out of Beijing, they're actually quite measured in terms of their views. They're not always massively bullish on China. What's really interesting is that, the biggest sector which is always under pressure is residential property more broadly. And so these two acts are more supportive for the property kind of sector overall. What we see as well is that there will be more government issuance of treasuries locally, which will be kind of basically for funding infrastructure and property exercises as well. So we think then that that's all positive. There was also a repercussion as well for retail mortgage rates as well. So again, that's supportive from a grassroots perspective. And I think us and Harvest, we expect that there's more to come from a fiscal policy perspective as well.
So you mentioned last week we did get a lot of fiscal policy measures very positively received by the marketplace. Again, my proxy is just Alibaba, because I know that company very well, up another 3% today, hitting a 52-week high, up about 50% year to date. But still, my big issue, and I think for a lot of investors' issue, is why China still may be uninvestable. I just don't know what the government's going to do. Any given day, they can come along and say, tech, we don't like you.
Yeah.
And we're going to enact a bunch of policies that are going to impact your business. And there's nothing an investor can do. How do you view that risk when you talk to clients? I guess the geopolitical risk just within China. Yeah,
so we do think that China, there's no right or wrong answer. That's what's making markets interesting as well, these diversions in thought. So, while we have been speaking about our ASHA and our ASHS tickers with investors, for those that are more cynical and maybe have a similar view to you, Paul, in terms of what are the surprises that can happen, we've actually been speaking to investors for coming up to a year about a fund that we launched in collaboration with Solactive and J.H. Whitney, which is CRTC. Think of it as DMX China. So we always talk about EMX China, but it's important to think about DMX China. So for example, tech, a great example, you can think about then the party is going to say, okay, all government officials, you can't have an iPhone. And then you see market cap of Apple drop, right? And so CRTC, the US National Critical Technologies ETF, is tracking an index which is ultimately looking at economic exposure to China, Russia, Iran, which is becoming more important as well, and North Korea, so these adversary nations from a US and actually more broadly NATO perspective. And so you're also then focusing as well on critical technologies, so at the same time it's also tapping into the categories which have been identified by the Department of Defense, which are going to maintain and even enhance the US economy globally. It's really about preservation of the US economic standing in the world.
Maybe spinning away from China just to international equities broadly, how are you feeling about prospects there in light of, yes, what we've been talking about, certainly what the Fed is doing as well. How much of an appetite do you have for them?
Yeah, so, I think when a lot of clients are thinking about the MSCI world, for example, so 10 years ago, the US used to make up about 40%, then that became 48%, and then now it's pretty much 60%. So everyone has got this inherent bias to the US. A lot of people thinking, is that too much? We've been speaking, for pretty much a year now about the Mag 7, and so thinking about diversifying it back into international equities is really interesting. We in particular really like Japan right now, and we still think that there's a carry component, even if the Fed has cut rates recently and looks to do so further. Japan is always pretty much a zero rates environment. But the Japanese economy, what's interesting is that it's moved away from having just an export focus, and actually the demographics are starting to change a little bit. There has been an increase in domestic consumption, for example, so this is kind of long-standing, we expect, and we think that gives a broader, nice story for dollar-hedged exposure to MSCI Japan.
Boy, when I first started on Wall Street in the mid-'80s, Japan was the bomb. You had to be in Tokyo. You had to do a tour of duty there. And then we went a generation with nobody, you couldn't, give it away. I just don't know what's changed there. Has the economy materially changed? Has the government policy changed? Why are Warren Buffett and people like you talking about Japan?
Yeah, it's a value trade, basically.
Okay.
So I think you have to have the discipline to stay in it for the long haul. We did see some retrenchment in the past couple of months, but we think that the long-term projection is that it really makes sense on a 5-year, 10-year perspective.
Would love to get your perspective on sort of where the Fed goes from here and how much the ground changed after the beginning of this rate cut cycle for you and for clients as well. Has the perspective shifted such that you don't have to play the parlor game as much? This has kind of begun and going to continue with some momentum, or how much focus is the Fed still taking up in your psychic space? Yeah,
sure. So George Katrenbone, who is the head of our fixed income business for the US, has some great views on this. Definitely, I think he's a common, very popular guest on your side. What we think is that actually it gives an opportunity for credit again. So I think that there had been a rotation out of that. Where there had been allocations, it had been more on the IG side, but we think that high yield, we've actually liked high yield long term, but we just haven't seen much in terms of flows into it. And so we're definitely thinking it makes sense now. What's really interesting, short duration high yield, so SHYL is our ticker, that's yielding about 8.5%, and the duration I think is like 1.8 years, something like that. We've seen default rates come down massively, even at the CCC level. So I think they've more than halved actually over the last 4 years. So much more robust than we have thought of it previously.
All right, Amanda, thank you so much for joining us. Always appreciate having you, particularly when you come in studio. Amanda Rebello, she's head of Xtrackers Sales, U.S. Onshore for DWS Group, joining us here in studio. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.